Greetings you all and welcome to the lesson. The subject is Advanced Financial Management. It is my hope that you are ready to revise the paper that was done on Tuesday, 5th of April, 2022. As usual, the paper has 5 questions which are all compulsory. Time allowed is 3 hours. I'll be answering a question at a time. In this session, I'm going to answer question number 1. In the next session, I'll answer question number 2. I hope you've gone through the past paper question and attempted the question on your own. Ensure that is done so that when I'm answering the question on the board, you compare the suggested solutions with what you have done. Question 1 has 2 parts, A and B. Part A reads, Treetop Limited is considering an investment project in the tourism industry worth 48 million shillings, which will be a diversification from the mainstream activities. The 48 million shilling project cost will be financed as follows: 10 million shillings using internal funds, 20 million using rights issue, 18 million with long-term loans. The investment is expected to generate a pre-tax net cash flows of approximately 14 million shillings per year for a period of 10 years. The residue value of the end of the 10-year period will be 15 million after tax. As the investment is in an area where the government wishes to develop, a subsidized loan of 8 million shillings out of the total 18 million is available. This will cost 2 million. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. Additional information number 1. The company's equity beta is 0.85 and its financing gearing is 60% equity and 40% debt by value. Number 2. The average equity beta in the tourism industry is 1.2 and average gearing is 50% equity and 50% debt by market value. Number 3. The risk-free rate is 5.5% per annum. 4. The market rate is 12% per annum. 5. Issue costs are estimated to be 1% of debt financing, excluding the subsidized loan, and 4% for equity financing. These costs are not tax allowable. Then lastly, number 6, the corporation tax rate is 30% required. The adjusted present value of the proposed investment project, 9 marks. Roman 2, propose 3 circumstances under which the APV may be preferred to the net present value approach as a method of evaluating capital investment project, 3 marks. So this is the question. We first answer part A, Roman 1, the adjusted present value, APV. Now, candidates, the APV method of project appraisal is an approach to investment appraisal that should be used if the financial risk of a company is expected to change significantly as a result of undertaking a project. So if a company is to undertake a project and the financial risk is expected to change significantly, then we use the APV method of a project appraisal. Now, what is the formula? First of all, I've always said when you have a question, put down the formula. We are answering April 2022 question 1, part A, Roman 1, Advanced Financial Management. APV, adjusted present value is equal to the base cost NPV plus the present value of the interest savings. We have interest savings, plus the present value of the tax shield minus the present value of issue cost, the present value of issue cost. This is a formula for APV for this question, because we have savings, as we read in the second paragraph, that there will be a subsidized loan of 8 million out of the total. This will cost 2% below the company's normal cost. That's a saving. So we are going to add this saving to the base cost. So this will be the formula. So we are first of all going to calculate the base cost. Then we'll have a working for the present value of interest savings. We'll have a working for the present value of the tax shield and the working for the present value of issue costs. So we're going to have workings. Working 1 is NPV, base cost NPV. We know candidates that NPV is equal to the present value of cash inflows minus present value of cash outflows. So to determine the base cost NPV, we get the difference of the present value cash inflows and the present value cash outflows. Reading from this question, candidates, you can see in the third paragraph there are two cash inflows. There are two cash inflows. The first one is that we read that the investment is expected to generate a pre-tax cash inflow. That is an inflow. Underline the word inflow. A net cash inflow. Pre-tax cash inflow of approximately 14 million shillings. That means that the 14 million shillings is inclusive of the tax, and the 14 million will be received for a period of 10 years. So that's the period. So that's the first cash inflow. The second cash inflow is the residue value at the end of the 10-year period, which will be 15 million after tax. So after the 10 million, after the 10 years, there will be a residue value which will be received after 10 years, 15 million after tax. So the 15 million is after tax. So we're going to get the present value of the two inflows. The first one is a 14 million. This is 14 million. This 14 million is inclusive of tax. So we remove the tax, multiply by 0.7 times the present value annuity factor. This is the interest that will be received annually, uniformly. It's an annuity. So we multiply by the rate times the 10 years. We don't know the rate, but we know the years. This is the first inflow. The second inflow is the lump sum, the residue of 15 million. 15 million. This is a lump sum that will be received after 10 years. So we multiply by the present value interest factor. We don't know the rate, but we know the years. So these two are the inflows, 10 years, minus the cash present value of cash outflow. The present value of the cash outflow is the 48 million shillings, which will be financed as shown in the question, so minus 48 million. So there are two cash inflows and one outflow. Now, candidates, we do not have the discounting factor. So you're going to have another working within this working to determine the discounting rate, not factor but the rate, the discounting rate. We do not have it. So you're going to have a formula. We will use the weighted average cost of capital, the weighted average cost of capital, which we know can be calculated by adding the risk-free rate plus the levered beta, the unlevered beta times market return minus RF, the unlevered beta. We do not have the unlevered beta. But from the question you can see, we do not have the unlevered beta. Do we have it? No. But we have the average equity beta in the tourism industry is 1.2%, and the average gearing is 50% equity and 50% debt by market value. So we need to calculate the unlevered beta. The unlevered beta we know is equal to the levered beta we divide by 1 plus debt equity ratio, all right, 1 plus the debt equity ratio times 1 minus t. This will give us the unlevered beta, okay, which will enable us to calculate the weighted average cost of capital. And the levered beta from the question, we are calculating the unlevered beta. From the question we have the levered beta, not number 2, the average equity beta in the tourism industry is 1.2. So this is 1.2 divide by 1 plus the debt equity ratio. The debt equity ratio and the averaging debt equity ratio is 50 equity, 50 debt. 50, which is 0.5 over 0.5 times 1 minus t, 0.7. That will be the unlevered beta, which is equal to 1.2 divide 1.7. This is equal to 0.706. That is the unlevered beta, which will help us calculate the weighted average cost of capital. The risk-free rate is it 5.5? Yes, 5.5% plus the unlevered beta 0.706 into the market return is 12% minus 5.5%. This is equal to 5.5 plus 706 into 12 minus 5.5. This is equivalent to 10%. So the weighted average cost of capital is 10%. So this 10% is the discounting rate. So I'm going to have the discounting rate there of 10%. So I have 14 million times 0.7 is 9.8 million times PVAF 10%, 10 years, plus 15 million times PVIF 10%, 10 years, minus 48. So 9.8 million times, I read the factor, this factor from the table, annuity. This is an annuity. This annuity, 10 years, 10%. 10 years, 10%. This is equal to 9.8 million times 10 years, 10%. 10 years, 10%, 6.1446. Yes, the annuity, plus 15 million. The lump sum, 10 years, 10 years, 10. 10 years, 10. This is 3855. Minus 48 million, which is equal to 9.8 million times 6.1446 plus 15 million times 0.3855 minus 48 million. This is equal to 17,999,580. So this is the base cost NPV. The base cost NPV is 17,999,580. That's the first working one. Base cost NPV, that is it. Then we have the second working to calculate the present value of interest savings. The present value of interest savings. Present value of interest savings. We read here that as the investment is an area where the government wishes to develop, a subsidized loan of 8 million out of the total 18 million is available. This will cost 2 million below the company's normal cost of long-term debt finance, which is 8%. So it's supposed to be 8%, but it will be below by 2%. So the 2% is a saving. So 2% is a saving. So we are going to calculate the present value of this interest saving, which is equal to the 2% times the 8 million times the present value interest factor at the rate, discounting rate, the risk-free rate we read there is 5.5%, 5.5%, 10 years. This we are multiplying. Then we remove the tax, 1 minus t. So 2% of 8 million, this will be equal to 160,000. Present value of the annuity, this is supposed to be an annuity because it's interest that will be received periodically, is an annuity. Now, the tables, we are not provided with the periods in decimals. The periods are not in decimals, and therefore, we'll use the formula 1 minus 1 over 1 plus r raised to n over r to get the present value annuity factor, the present value annuity factor. And this should be equal to 1 minus 1 over 1 point, this is 5.5%, this will be 1.055 raised to n, which is 10 years, divided by r. Our r is 5.5%, which is the same as 0.055. So this will be the present value annuity factor. Present value annuity factor. Going to have 1 minus 1 divide 1.055 raised to 10 divide 0.055. So here I get 7.538. That's the discounting factor. So you have 7.538 times 0.7. This will be the present value of the interest saving. So I have 160 million times 7.538 times 0.7. This is equal to 844,256. That is the present value of interest savings, present value of interest savings plus 844,256 plus the present value of the tax shield. That is working number 3, present value of the tax shield. Tax shield. Present value of the tax shield. Now, candidates, we read that as the investment is in an area where the government wishes to develop, a subsidized loan of 8 million out of the total 18 million is available. It will cost 2% below the company normal cost of long-term debt finance, which is 8%. So the question is, what is the formula for calculating the present value of the tax shield? So we are first going to calculate the tax shield, then we discount it. All right? We first calculate the tax shield, then discount the tax shield. So the tax shield, the present value of tax shield benefit. So first of all, candidates, what is the formula? There are two things. We have present value of the interest tax shield. So we are going to first calculate the interest. Then we apply the tax. Then we apply the present value annuity factor. So first of all, we calculate the interest, and we read from the question that as the investment is in an area where the government wishes to develop, subsidized loan of 8 million out of the total 18 million is available. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. 2% below. 2% below. That means that this loan will be split into two. There is the 8 million shillings loan and the 10. The total is 18. So we have the 8 million and the 10 million at different interest rates. So the first one is the 6%, and the amount is 8 million. That is the interest. The second loan, the rate is 8%. The amount is 10 million. That is the second interest. So 10 million plus 8 million is equal to 18 million. This is the interest. So to calculate the tax shield, we apply 30% on these two. We apply 30% on these two. Then we get the present value. We multiply with the amount we get here with the present value annuity factor at 5.5%, 10 years. 5.5%, 10 years. Because it's an annuity. Interest is an annuity. So we're going to have the answer there. Interest 0.06 times 8 million. That is 480. It's 480. Plus 0.08 times 10 million. It's 800. 800 plus that will give me 1280 times 30%. Times 30%. 384 times this factor we had calculated there, because is 5%, 5.5%, 10 years. We raised it to 10 to get 7. This is times 7.538. Okay. So that will be equal to times 7.538 I take it again, 480 plus 800 times 30% times 7.538. So this gives me 2,894,592. 2,894,592. So that is the present value of tax shield benefit, 2,894,592. We deduct the present value of issue cost. That is working number 4. present value of the issue cost. Now, how do we calculate the issue cost? Look at note number 5. The issue costs are estimated to be 1% of debt financing, excluding the subsidized loan, okay, and 4% for equity financing. These are not tax allowable. So we're going to first for calculate the issue cost, then we discount the issue cost. We get the present value of the issue cost. And the issue costs are in two categories. The first one is the loan. Let me have it here. The loan, we have seen the loan is at 1%. And the loan we read 1% of debt financing excluding the subsidized loan. Excluding the subsidized loan. The total is 18 million. The subsidized loan is 8 million. So the difference is just 10 million. That is it. Then there is the rights issue. Look at the second sentence, which reads, the 48 million project cost will be financed as follows: 10 million using internal funds, 20 million using the rights issue. So we have the rights issue. Using the rights issue, and the rights issue we see the issue cost is 4% for equity financing, 4%. So it's 4%, and the amount we've read in the second sentence is 20 million. So 1% of 10 million in relation to the loan, 1% times 10 million. This is equal to 100 million. Then 4% times the 20 million is 800 million. It's equal to 900 million. So we get the present value. Present value of the 900 million. And this is in present terms. It is at start. Okay, the company is to raise this money now before the project begins. So we are not going to discount the 900 because this 900 is already in present terms. This loan will be raised at the start of the project. The rights issue will be issued at the start of the project. So this 900, we will not discount it. 900. Okay. So that is that's it. We have the base cost, we have the present value interest, we have the shield, the tax shield, we have the issue cost. So what is the NPV? So I'm going to add 17,999 580 plus 844 256 844 256 plus 2894 592 minus the 900. This should be 900,000. This is 900,000, not million. This is 900,000. These are thousands. Because if you apply these on that, you get 800,000, which is equal to 900,000. 900,000. So minus the 900,000 So the APV is shillings 20,838,428. That's the answer to that question. How many marks? 9 marks. So first of all, I said when you have such a question, put down the formula. Then you'll be guided by the formula on the inputs. So first of all, you calculated the base cost NPV. So when you come to the base cost NPV, again, put down the formula. Then go to the question, check, do you have the present value interest, the present value of cash inflows? These are inflows, these are outflows. So be guided by the question. Read through the question, identify which are cash flows, which ones are inflows, which ones are after tax, which ones are pre-tax, and so on. So all these would earn a total of 9 marks. All these are workings, important workings. Workings, 9 marks. So let me answer the other part of the question. Propose 3 circumstances under which the APV may be preferred to the net present value approach as a method of evaluating capital investment project. Now, at the beginning, I mentioned that the APV technique is used to evaluate or to appraise investment projects if there is a financial risk of the company, if the financial risk of a company is expected to change significantly as a result of undertaking a project. So if a company plans to undertake a project and there is a likelihood that the financial risk is expected to change significantly, then you use the APV technique. So the question here is circumstances. Propose 3 circumstances. Roman 2, circumstances. These are circumstances under which APV may be preferred. Under which APV may be preferred. Now, the first circumstance, number 1, is that the APV may be preferred where the firm's capital structure is dynamic. Dynamic capital structure, where a firm has a dynamic capital structure. If the capital structure of a company is dynamic, then it is advisable the company to use the APV. All right? Dynamic capital structure. Now, the second circumstance is where the firm wants to account for other financing side effects, such as equity issue costs, like what we have done in our question. These are equity issue costs. We calculated equity issue costs here. The rights issue, that is an equity issue cost. So where a firm wants to account for other financing side effects, such as the equity issue costs or cost of financial distress, then it's preferred that the company uses the APV technique or method of evaluating projects. Do you understand? Where a company wants to account, a firm wants to account for other financing side effects. Financing side effects such as the equity issue costs. Another circumstance is that the APV can be used where a firm is one that is highly leveraged firms, or leveraged buyouts, where one firm acquires another from debt to finance the purchase. The LBOs, leveraged buyouts. Leveraged buyouts. A firm buys another firm that is highly leveraged, and the firm that buys relies on the assets of that company. Leveraged buyouts. Or highly leveraged firms. Highly leveraged firms would rather use the APV method as opposed to the NPV method of evaluating capital projects. We can add number 4, the fourth circumstance. Candidates, you are discussing the circumstances under which the APV may be preferred over the NPV. Complex funding arrangements. Where a firm has complex funding arrangements, then it's advisable the company to use the APV technique as opposed to the NPV technique. We can even add financially distressed firms. Number 5, financially distressed firms should use the APV technique. So these are 5 circumstances. Candidates were to give just 3. We have 1, this is 1, 2, 3, 4, 5 circumstances. Any 3 would earn 3 marks. We've answered Roman 2 of that question.